Hello, everyone, and thank you for the introduction. I must admit, it's my very first time speaking at a conference outside, and then it's amazing, at least for me, who's been sitting in the shade. I won't say too much about Rystad Energy, but I'll say one sentence just because it's quite important for the session today and my role. And that is that we are an independent data and knowledge house. We have no assets, no vested interest in any energy projects, and this is key for my objectivity today. But back to the question at hand, can the market deliver on the climate finance needs of the emerging markets? And to understand that, we need to take a step back and understand which energy demand and more importantly, which power demand growth we expect to see from the emerging markets going forward. So on the page behind me, you see the growth in power demand between 2025, meaning today, and 2035, split between OECD countries and emerging markets. And not surprisingly, probably to many people in this room, there will be a large growth in energy and, not to say the least, power need as the world is increasingly electrified. But what I want you to take away from this slide is that if you compare the emerging markets to the OECD countries, both in absolute and relative terms, the growth in power demand will be larger. And in fact, the emerging markets will add more than half of what they're currently consuming today between 2025 and 2030. And the question then begs, what will be the sources that supply this increase in power demand? And if we look at the current power mix today in emerging market, it mainly comes from fossil fuel sources, which is this brown part in the chart. So will they continue to invest and install more fossil fuel energy, or will they choose to go the renewable route? Well, a key driver into that is to understand the competitiveness of renewable sources. And on this chart here, you see the cost of renewable energies between early 2000s and 2023. And renewable energy technology is mainly, it's a very equipment-heavy technology, which means that you can add standardization and scale to drive down the cost. And that's what we've seen over the last 20 to 30 years, that the costs have fallen dramatically due to the scale and the standardization. And it has even fallen below the fossil fuel alternatives in many cases. And that should make you think, well, it will be a no-brainer then. The emerging markets will turn to renewable energy as that is the most cost-competitive source. Well, I wish it was that simple, but it's not. Because the equipment-intensive nature of renewable energy also makes it more capital expenditure heavy and sensitive to the cost of capital. So on the chart here, you see the cost of power on the y-axis and the cost of capital, and I put solar PV and coal as the comparing energy sources on the slide. And while yes, solar may be cheaper in many countries around the world, with increased cost of capital, we can see that solar PV actually moves above the cost of coal in many economies. And this is a key issue for emerging markets for the reason that the cost of capital is higher and the access to capital is lower. I want to start with the cost of capital, and this is a quite text-heavy slide, not to my liking, but I'll take you through it. On the top row, you see the equity risk premium, which simply put means the additional returns that the investors need due to risk. So they need this additional in return. And that is around 10, or to be more precise, 8 percentage points higher in emerging markets compared to OECD countries. And as we've now learned, this has an effect on the cost of power, and especially renewable energy. And on top of this cost, there is lower access to capital in these markets. So if we look at the GDP per capita and the foreign direct investment, which you see on the two next rows, you see that it's about 10 times lower in emerging markets. And to provide you an example of the consequences of that, I'm going to show you an example of one country that we've already mentioned today, namely India. India is the largest country in terms of power demand today and in the future, and we expect them to add more than 1,400 terawatt hours to their power consumption before 2035. That's almost 10 times the Norwegian power consumption. And this will cost north of $300 billion USD. And with an additional cost of capital or an equity risk premium of 7.5%, this could actually push India towards a more fossil fuel heavy route than a fossil free one. So with that, I want to thank you for your attention.